I think I bounced around a little bit, but like I said, it's hard to talk mortgages and we're going different levels of ownership and experience in here, so I didn't.
Thanks for the information.
Okay, my name is Cassie Wells. I work at Keller Williams Realty. I have been in real estate since 1995. I've been specializing in investment properties since 2003. I am a CCIM, which is Certified Commercial Investment Manager. There are only 36 of us in Central Arkansas, and there are only 3 that are female. I am so happy to see so many females in here. I work mostly in a man's world, mostly who owns property are men. So I love to get females into the investment world. I personally, at this moment, own 3 houses. I have owned a mobile home park in the past. I have owned some duplexes in the past. I've owned some other houses in the past that I've sold. So, because I feel like if I was going to get into selling investment properties, then I needed some investment properties to know the pains and the struggles of owning investment property. The first thing when you're going to get into investment property is you need to figure out where you want to buy. It might be in the city that you live in, and it might not be in the city that you live in. And then when you pick a city that you want to invest in, then you need to do some research about the different areas that you can invest in. And you will pick an area based upon what you are looking to do, because you can buy for appreciation. That means if you want to buy in an area that appreciates a whole lot, or you can buy in an area that cash flows. So you either want to buy someplace that in 10 years the property values will go up, or you can buy, for example, I have one client, he loves to buy in Maumelle. So he spends about $150 to $175 on houses, and then he rents them out, and in 10 years, his whole thing is that they're going to be worth a lot more than what he's paid for them now, and he'll leave them to his children because he doesn't need the cash right now. I personally like cash right now, so all of my rentals are in Southwest Little Rock and out Arch Street. So they take a little bit more time to take care of and to manage than a house in Maumelle or West Little Rock. So it just depends on, you know, how much time you want to devote and what you want to do with your, you know, what, and that's the great thing about working with investors is that even though I've got 100 investors I work with, they all want something different. They all look at it differently. They all want to buy in different areas. So that's how I can work for so many different investors. And then after you pick where you want to be at, you need to pick what you want to buy. You can invest in a house. You can invest in a triplex, duplex, fourplex, or even more than that. I've got right now a triplex in North Little Rock that's under contract, and the gentleman that's buying it is a veteran, and he's going to live in one side, and he's going to rent the other 2 sides out. The other 2 sides are already rented out, so it's going to work out real good for him. So, and then I told you about the guy that likes buying Maumelle. So then after you figure out what you want to buy, and that will probably change a little bit too. You might start off small. You might buy a few little houses, a duplex, a fourplex, and then go to something larger. I always tell people to start small. You know, this is not a get quick rich game. This is a long-term, just like your stock market. It's a long-term 20-year investment on that part. So, and the people who do, you know, are reading all the books on how they can get rich quick on real estate, don't really work with them because that's just not what you want to be into on this game and everything. So once you decide what you want to buy and where you're going to buy it, then we need to analyze the property. The most common way of analyzing a property is looking at the cap rate. I've got some definitions here. And a cap rate is your net operating income divided by the value of the property, the list price, the sales price. So what you do is you take your rents, you subtract all of your expenses, and then you get that net operating income, and then you can divide it into the value or the list price, and you will get a percentage. The cap rate will change depending on where you're buying. For example, in West Little Rock, you might have a cap rate of 5 or 6. In Southwest Little Rock, you will probably have a cap rate of 7 to 8%. But the risk is larger so if the risk is larger, then your cap rate's gonna go up because people wanna make sure that they're getting their value. Another example is like interest rates. When interest rates are low, the prices go up because you're still gonna have the same cap rate. So, and right now, prices are pretty high for most investment property. I've sort of been surprised at what some investment properties have been selling for around town. There's a few other ways people value property. Number 4 is cash on cash. That's the cash return yearly. So some people, they want to say, I'm going to put $10,000 down. How long will it take me to get my money back? Because once they get their money back, then it's basically running itself. So some people like to figure it up that way. There's also a gross rent multiplier. Some people use that. And then there's an IRR, internal rate of return. And I've got that on here too. That's another whole subject in itself. And then what's your main goal though? You buy and you hold, but you can also do number 5 here is a 1031 exchange. You can buy a couple small properties and then you can sell those properties and defer your taxes and get into a larger property. A lot of people do that. That's the way that they save their equity. So if I buy a house for $10,000 and I save it, I save it for 5 years, and at the end of 5 years, I've got a house and a duplex, and I want to sell both of those. They both appreciated. I want to sell those. Then I can do a 1031 tax exchange. I can go close on those properties, and it gets a little complicated, but you hire another company to hold on to that money, and then you can go buy another property and put all that money into your property. And the taxes are deferred. And you can do this over and over and over again. Now, when you sell the property, dispose of it, and don't buy another property, that's when you get hit with your taxes. But the main gist on that is you keep doing that until you retire. And at that time, your taxes are less. Or you can keep doing it until you're no longer here and your heirs inherit the property. And when your heirs inherit the property, then their basis is when they inherited it, not when you first bought it. So that's another way of making wealth on that part. So let me see some of these other terms. Appreciation is the increase in the property. We all want our properties to increase. And when you buy, the difference between buying a house as an investment and buying a multifamily, because I have people who buy both. A house, you can always fix it up and sell it to an owner occupant, and it will appreciate a lot quicker than a multifamily. A multifamily property, really the only way that you can appreciate on the multifamily is by raising rents. An example of that is I have a client who bought 5 duplexes from me probably about 10 or 11 years ago. He calls me at the beginning of this year and he says, I want to sell them. I said, okay, this is what we can get for them. He says, nope, I don't want that. I want this. I said, well, if you want this, then you are going to have to raise your rents by about $150 on each of them. So he said, I don't know if I can do that. I said, well, we're not going to get that money if you don't raise your rents. So that's what he's been doing for the past year. He has been, as people move out, he's raising the rents, finding that he's raising the rents really easy. And so after the first of the year, we will be listing his properties. I won't make him raise all of them, but if he gets, out of the 10 units, if he gets 6 to 7 of them up to the high point, which he's almost there, then I can have the ability to convince everyone else when these people move out that you have the ability to raise the rest of the rents. Yes.
So the purpose of him raising the rent is so a potential buyer can see that's the profit you can make because of that?
Correct,
Okay.
correct. Right now, he is only, and this is a 2-bedroom in-law male. He was only renting, well, 2 of the people have been there since before he bought it 11 years ago. They're only paying $450.
For a 2-bedroom?
Two bedroom. And then the rest of everyone on the street. And then the other ones were renting for $600, $625. I was like, no, we're gonna get them up to about $750. So he's been renting them for $750 on that part. So, and now everyone on the street is raising their rents too. So that's a good thing. But I just couldn't believe he was renting for so low. You know, at the, and he's gonna add about $25,000 value to each unit by raising the rents that much. So, you know, and that's what I do too. I'm a real estate counselor. I counsel people on where to buy and what to buy. And then I also counsel them when they get ready to sell. Because it might take someone a year to get their property ready. Because, you know, if they want to maximize their sale price, then they need to do that and everything. So, adjustable rate mortgage, just what it is, it does adjust, and a fixed rate is fixed. If it's a 4-plex or less, you can get a fixed rate, conventional, Fannie Mae, whatever. But if it's over a 4-plex, then you go into the commercial loan, and that will be refinanced every 3 to 5 years. Turnkey properties are one that just move in. Capital gains tax. There's short-term capital gains, and then there's long-term capital gains. Short-term capital gains, if you own something for a year or less, you will be taxed at your regular tax bracket. If it's over a year, that's long-term capital gains, and that's, I think it's 15% federal and then 5% on the state. And those change because they started to take that away from us and left it there, which they need to. So, and then closing cost and inspection contingency. You always have an inspection contingency. Now, the most important thing that I can talk about, and this is what I talk about with anyone who wants to get into investment property, and that is managing it. What are you going to do with the property after you get the property? You can hire a property manager. They're going to take anywhere between 8 and 10% of the income. I self-manage. I do not hire a property manager. You're not going to find any property manager who is going to take care of your property the same way that you would take care of your property. So, you know, if you don't have 50 units, it's pretty easy to self-manage. And, you know, I had a client that came here from California, and he bought a 23-plex from me, and triplex from me, and another 12 units from me. He's had a horrible time with property managers in town. And after 3 years of going through 3 different property managers, we decided to liquidate his property. So, whenever anyone calls me and wants to get into this, that's the first conversation I have.